Hello there, Oak Bloke here, and this is going at Watkin Jones. So I've written an article today. So usually I'd record the video and then publish the article sometime later. I've done it the other way around just for a change. And this article is at my Substack, which is theoakbloke.substack.com. So long and short of my article is that I'm still digging it, which is to say, look, you know, my first read of the results and the results of these here you know, the weren't stellar results. They were sort of okay, but not amazing. So revenue revenue was a little bit just a little bit down, you know, and gross profit down, operating profit down, profit before tax down, and earnings per share down. You know, everything's down on the face of it. So you could look at these results and say, well, you know, comparing that to that, pretty awful. But if we sort of say, well, let's compare, you know, other time periods that you know, if we sort of say compare to these periods here, 2022, 2023, or even to the final period, last 6 months, where they you know, like broadly comparable, actually, six months to 6 months. So it's just the fact that they're comparing this period to this period, that you could sort of argue or look at it on the face of it and say, oh, well, it's not a very good result. Well, yeah, you know, I take the point, but I think the other point I would make, though, is that was based upon very, very minimal amounts of activity. So this sort of 2025 pipeline is and then this is the remaining pipeline. So we're sort of looking like we'll get to 226 million by the end of by the end of the financial year, which is the end of September, which is 2.5 months away. Which isn't itself great either, because that sort of looks like we'll end up at something like a minus 3.6 million loss for the year, 2.9 in the second half. But I mean, even without anything further happening in 2026, we are now looking at a profit in 2026 is my estimate. Obviously, these numbers are not guaranteed, but what is sort of nailed down is this pipeline of work, 292 million, which I'm taking from this 294 here. Sorry, it's this this value here, and then I'm adding in the value of fresh and the value of refresh, because what we're seeing here is this is the pipeline, and they report pipeline of PBSA, which is purpose-built student accommodation, and they report the build to rent, and they report the affordable homes. So this, you can sort of see them here in this column here, that this is sort of 3 parts of the business, whereas the other 2 parts of the business don't sort of have they're not the same sort of beast or animal where you've got like these large projects. They tend to be sort of smaller. In the case of Fresh, it's an ongoing building management contract, okay? And in the case of Refresh, I mean, funnily enough, Refresh, they have actually reported a pipeline. So the presentation deck shows us that pipeline of Refresh is 300 million. Let's see if we can just grab that. So it's just down here. Look, so pipeline of 300 million, of which 57 million is in negotiation. 4 million is kind of in progress. You know, on site, I'm taking to mean that it's sold. They're on site. They're not on site sort of saying, here's a quote, mate. They're on site delivering the refresh being a refurbishment. Um, and it's interesting because this actually says that it's a £5 million work package which has 50 million plus of later phases. So this negotiating contracts 57. I mean, it's almost certainly like pretty much that deal there. So in other words, like as long as you're happy enough that they are going to do a good enough job on the 5 million bit, that the 10 million, oh sorry, the 50 million bit, you'd like to think is fairly nailed on. And when you look at what they're sort of managing to do with their delivery, you know, they're able to get excellent rating on considerate contractors. They've on in terms of student feedback, they're getting plus 62 NPS net promoter scores. So there's quite a few reasons to think that they do a reasonable job or a good job. I've never had the pleasure, but you know, they seem to have a solid reputation. So is this 57 pretty nailed on? It feels like it could be. I mean, there's a better than average chance to it. And then for the rest of it, it's 238 million. Well, who knows how solid that is? But again, you know, if all of that came in, and that's just what the current pipeline is, and the pipeline 6 months ago was at 200 million. So they've grown the pipeline by 100 million in 6 months. And obviously managed to get sort of some of it closed as well. Um, that and actually the interesting thing about that is that the margins on it are above average. So rather than kind of 7-8%, 6% percent on the refresh projects, higher margin work. Okay, to comment, this is the PBSA. Obviously, this has quite good margins as well. So, and obviously, because these refreshes are for PBSA as well, who's to say that the margins can't get more towards this kind of level? You know, that maybe 13.8, 14 is just the beginning. You know, like normally when you get started on a new type of project, a new type of that it takes a bit of time to get into it. So anyway, that's kind of my take on that little bit of it. So as I say, not stellar results at all. I mean, you know, it's kind of okay. But I mean, what I've done in this article is break it down into 5 things. Number one, successful completion of projects. Number two, careful cost management. Number three, just the fact that they've got these new sources of income. Number four, the outlook for PBSA and build to rent BTR, and then just looking at the pipeline and what they mean by inline, because they said in the update that they were expecting an inline outcome for 2025, and yeah, just kind of looking at all of those aspects. So I worked through all of the divisions, the segments, and you can sort of see going back 3.5 years, you know, the results are not spectacular. Obviously, this part of the business is new. This one's bounced from a loss back into a profit on affordable homes, so that's good to see. Not spectacular margins, but you know, 6% is better than a poke in the eye, I guess. This one, the fresh, again, you know, they managed to pull off a good result, so it's sort of more in keeping with previous periods. Obviously, this dropped from period to period. So in my article, I questioned the strong growth when it was sort of strong contraction. But I think what they mean by strong growth is strong future growth of future pipeline. Obviously, that 300 million pipeline is what they mean by strong growth. And obviously here with the student accomo, I mean, again, it's dropped massively because this is just tailed off during the period. But as I say, I mean, there's reasons to think that with the new projects in the pipeline and coming on board, there's reasons to think that that's almost like a potential low point for 1H25. This part here is just sort of working through the numbers that they recognised further costs of cladding. That sort of tipped it over the 100 million mark, which I thought was notable. By the way, these are not sort of, this doesn't directly reconcile back to the balance outstanding, which is 45 million, because what I'm doing here is I'm just keeping a tally of how much have customers stumped up, how much has actually turned into actuals from being a provision. Because the way it works with provisions is if you think you're going to have to pay for something, in this case, I think I'm going to have to set aside 100 million quid. Okay. Most of that or some of that I set aside in 2020, more of it I set aside in 2022, more of it I set aside in 2023. And you can sort of see it is tailing off in terms of the amounts now that we're no longer sort of adding 30 million of provision, but we are adding 8 million, 4 million. Although it's interesting because you'll see here this cost recognition. This is the sorry, this one here, offset. Offset is the amount that the customers are adding to their liability. So it was completely offset by, so even though this was an extra liability, it wasn't Watkin Jones's liability, it was the customers, the building owners. So a new building was identified, and whoever owns that building was like, oh yeah, I'm going to have to pay the bill. Perhaps conversation wasn't exactly like that, but you get the idea that it was a complete offset. Now, we've not seen that before. Up until now, it's been like, 8 million of new liability, 1 million of offset. Oh, yeah, the customer's going to pay 1/8. Now, this time, this period, they're paying 100%. That's a big improvement. And here it was a third, and back here it was nothing. And I think this is sort of indicative of what could happen. That that's the other thing in the interim report, is that this isn't a final figure. That, I mean, this might be a final figure, or at least there's a time limit now as to sort of, they say another 12 months, and then this will be a sort of finalized liability. Whereas this is under negotiation. So and it's also just depends on what the law says and how the law is interpreted as to who is liable. But also, it's fair to say that the existing liability is this amount here, by the way. Well, the liability is 57 million. Of that, 11.8 belongs to the customer, belongs to the building owner, of which then Watkin Jones is liable for 45 million. So but that 45 is not just on the basis of like, oh, each building's 0.8 of a million, and we've got 55 buildings, so 55 times 0.8 is 45. It's not that calculation is not like that. The calculation is that we've got maybe 20 buildings that come to, let's say it's 20 million. I don't know the exact number. I don't think anybody knows the exact number, except it's not been disclosed to Watkin Jones. Hopefully know the right number. But something like, say, half of that number is actually just going to be a sort of a just in case number. So think about that. Potentially, the just in case may never happen. In fact, probably won't happen. If that's true, then that liability drops from 45 to 20. And if half of that is customer and half of that is Watkin Jones, the final liability is actually only 10 million. And that makes a massive difference as well. I think it's not clear to me that either that there's going to be any further increases to it or anything substantial that will increase it, nor do I think that this is the full figure that they'll end up paying. I think it will be but I don't know that for sure. I mean, it's open to yeah, it's open to continued negotiation. So otherwise, on cash, I mean, they've got 73 million net, which is more than the market cap. The market cap's 63 million. They've got 73 million, so they've got more cash. If they bought back their own shares, they'd be able to buy them all back. Nobody would be a shareholder, and they'd have 10 million left in the bank, assuming they could buy it all back at 24p, of course. But anyway, you get the idea that they're pretty cash rich, and that cash rich, I sort of tongue in cheek say, well, if they sort of didn't sell a single bean going forwards in the world, if they didn't sell a single bean, they could keep going. Just to show you this, based upon this sort of pipeline here, they would lose 3 million this year. So by September, this is by September 2025. The following year, they would, based upon the pipeline, they would make money. And what I'm doing here, as I say, this is the 251 that's in that pipeline. So it's that 251 there. Okay. Plus I'm including a value for fresh of 9 million, and I'm including a value of refresh of 32 million. So what I'm doing is I'm taking the refresh in negotiation, that 50 million follow on. I'm assuming that's gonna happen, which you could disagree with vehemently and say no, that's nonsense. And of course it's not official, but I think there's a really good chance that they'll do stage one, they'll get the follow on stage two. So on that basis, they'll actually turn a profit. So up till sort of 2027, that 73 million is more or less intact, because this is sort of including overheads. You can see here I've sort of boosted the overheads from 14 million for half a year to sort of 15 million per half a year. And then so basically the cash will run out sometime after 2028, after sort of these this is based upon the fact that in 4 years time there's only 57 million in the pipeline, and that includes 9 million of fresh and 0 of refresh. So I'm not assuming anything for refresh because we just don't know, do we? I'm assuming that that in negotiation stuff is likely to happen, so I'm including that in the model, but nothing else. So all of this kind of, this will sort of exhaust the cash pile, and I'm also assuming that the full 45 million is taken as well. So that means you're only left with 28 million, and you can see like that, taking that from 28 million, at that point Watkins Jones is bust. But that's literally that they've got to sell nothing, they've got to close no further deals, there's no further projects, there's no further wins. And like, the reason that I just think that that's very unlikely, I mean, a couple of reasons. Number one, pipeline. Number one, you've got all of these deals that are kind of contracted, but they're looking to finance them. Okay, so these ones in pink, or whatever color you think that is, I suppose peach, and everything in peach is a secured pipeline. This is the 1.1 billion, but it's 437 million that kind of hasn't been given, hasn't had the finance, hasn't had the go ahead. So it's got planning permission, they've got sort of the agreement in principle, but they haven't yet got the partner, they haven't got the funding. Okay, so that's kind of, this, so none of that could close. What you'll see is that there's a further, like, these are just all the ones that were listed on the Watkins Jones website. So beyond all of these that were listed that had a value, and you'll notice some of them I've said estimated, and that's based upon, I'm sort of saying, student accommodation is 163 grand sort of price per bedroom. BTR is 286 per house. So I'm sort of I'm making estimates on values to come up with these numbers, to come up with that 437. So basically, I'm probably undercooking the numbers because there's 164 million that's missing out of these numbers here. In other words, this 1.1 billion minus all of these leaves 164 million. Okay, so there's 164 million, but also the unsecured pipelines. This is the other thing, that you've got a secured pipeline of 1.1, and you can see it on this part of the presentation where they show you this bit here, where you've got 1.95 pipeline, and this stuff is where the site is secured. This is stuff where the site is secured and they've got the planning. So here they've not got the planning. STP is subject to planning, and then forward sold is literally like, yeah, we're doing the work, we're going ahead with the work. Unsecured in legal slash exclusivity, I mean, that is that sort of unsecured part, that 850 million, is basically, it's in legals, it's in exclusivity. So they're talking to Watkin Jones. I mean, again, none of this can close for them to run out of money by 2029. So like, I suppose the point I'm trying to make, a slightly tongue-in-cheek way, is, well, the chances of nothing closing in all that period of time, plus no further refresh deals, so that 300 million of pipeline and 100 million worth of new pipeline in 6 months, like none of that can close either, apart from that 57, in order for that model to carry on. So in other words, I'd say, it only takes, well, even what, 10% of that pipeline there, and that any deal whatsoever will forestall its going bust. And if a couple of deals come in, I mean, bearing in mind as well that if you go and look at the news flow of the past 12 months, I mean, and this is it here, that that, I mean, obviously some of these are they're working on the existing pipeline, so that one's existing pipeline, that one's existing pipeline. That's a new deal they've closed, so that's a refresh deal. If we go into here, that's another one that they completed. But if we go back to 2024, so they got a 295 home deal here. This is affordable homes. They got that's obviously a completion. um, they got a go ahead on 1,000-bed scheme in Belfast. They got the go. Sorry, that was a completion. That was appointments. But and that's just going back, what, 4 months. They got the go ahead on a 784 scheme in Glasgow. They got that's a completion. That's a completion. That's completion. But you get the idea that when you only have to go back 6 months, 12 months, and if they just even do what they did in the last 12 months, and the last 12 months haven't been a great 12 months for and there's another one there for 484, and we've gone back 6 months, and there's what, 3 4 deals. um so, if, I mean, and totally appreciate that somebody could come back and say, oh, hang on a minute, like nothing much has happened in 2025, and that's true. Like, there's been no new deals apart from the Venti house deal. Although when I did do some sort of digging around and looking at the news flow, there was things that weren't in Watkin Jones, like this one here about King's College. That isn't in the news and insights list here. No mention of it. But this was I think this was PBSA Weekly or something like this, some news publication, um, that said the planning application for the refurbishment and remedial works was submitted in the year 202 in November, with consent given in January 2025. Construction will be led by Watkin Jones Group, and will start next. I forget whether it's next month or next year, but anyway, it's so that you've got this this deal that's not in an RNS, not in any official news flow, but has been reported in the press. You've got other examples of that as well. So that's I suppose that's the point that I would make, is that it just seems very unlikely that there'll be 0 deals, and if there's as many deals as there was last year, this year, well, they're well on their way to, well, they are sort of on their way to making a profit, and a growing profit. And that's just based upon sort of current situation. So anyway, yeah, as far as I can see, the the point about cash is not one that I'm concerned about. Refresh, um, I thought yeah, I mean, there's a couple of deals here with refresh, so that's all looking good. I mean, if this is the one that's the 57 million deal, obviously Stratford's a very busy and up and coming place, so several universities nearby, so all good. That's a good one to be working on. So happy with that. And obviously that one, King's College London, another good one. So yeah, just all positive. in terms of build to rent, I'd make the point that looking at other parts of the economy and other shares, that the amount that's going into lending to buy to lets, build to rent, same sort of thing. Um, Letting and renting, that I've seen stuff where the amount of lending is doubling, in the case of Lend Invest. It's growing in the case of Paragon, growing in the case of Secure Trust Bank. So lots and lots of indications that the market is thawing. Just looking at other data points. Also interesting that the lending rate, the cost of lending, or cost of borrowing rather, is dropping. So the mortgages are based on SONIA swap rates, 5-year swap rates. So that's positive. Obviously, that difference there isn't on the face of it massive. It's 14 points, 14 basis points, but that over the course of a mortgage will be thousands of pounds of difference. So I mean, it does and can make the difference on investment decisions. So yeah, don't and below 3.7 is it starts to feel acceptable again. Anyway, that's and then on student accommodation again, just looking at the number of students, near to 3 million was the peak. We're now below that. We don't have up to date 2025 figures, but I mean, even if they've dropped 10% or even 20%, 2.3 million is well above the historical. You can see it here, and this part here, the yellow and the blue. I mean, this is university PBSA. This is private sector PBSA, and that's what, 20% of the supply. In other words, that students end up having to rent and compete with buy to sort of tenants and buy to rent providers. They have perhaps the decision to stay at home and go to university, whatever their local university is, sort of living at home, or mummy and daddy buy them a house. Own residence is another option, and other and not known. Well, who knows? But there's larger and larger numbers of those. So, in other words, the whole sector is a mess. You could grow the yellow and the blue all day long, and you'd still not fill the gap that exists in the market. So, and where there's a gap in the market, there's an opportunity, and where there's an opportunity, there'll be an incentive for investors and an incentive for providers, so builders like Watkin Jones, to address this market. So like from my point of view, it looks like a bottomless pit of demand. And even if, because I did have a reader say to me, oh well, there's a lot of pessimism within universities and the numbers are dropping. Completely accept that they could be, but I also would question that even though Britain has tightened up on things like, like a student coming from abroad can't bring their mum with them to study. Not, I mean, certainly my mum wouldn't want to come to university with me to study for 3 years, but you like, okay, yes, there's a slice of the market that maybe we're sort of paying to come over as a student, but um, if you don't come because you can't bring your family with you, in most cases that was because they didn't want to be a student. So I would guess, I would expect there's an element of that what we're cutting down on is not students. We're cutting down on economic migrants who are using the cost of PBSA and a student university course to gain entry for themselves and for their family, which is not what that visa is intended for. And so if the government have closed that loophole, well, you can just sort of look at that from a moral and from a whatever dimension. I just don't think it's going to have a huge effect from a business point of view and from an investment point of view on the demand here, because the number of students would have to dramatically fall by many millions per year in order for there to be a surplus or a lack of need for more PBSA. So I'm pretty comfortable about the odds are stacked very much in the favour of Watkin Jones at this stage. It's also the case that when you look at the amount of supply, for 3 years now, what is it, about 12,000 new beds per year have been added to the market. So you sort of think 12,000, that's sort of like, a millimeter of that graph per year is being added to the capacity. Like, it's nothing. The capacity is absolutely nothing. And in terms of the deals that Watkin Jones could close, I mean, we're talking, again. Let's just sort of put this into context. So we're talking about, even if the entire unsecured pipeline closed, and obviously not all of this is student accommodation, but let's imagine it were. I mean, 11,550. If the entire Watkin Jones pipeline closed, the effect that that would have would be to bring back the number of PBSA beds added to 2022 levels. That's all it would do. In other words, and the likelihood of 2 billion of orders becoming forward sales, I mean, that'd be a nice problem to have, but the chances of that are quite low. So you could sort of hopefully get the sort of, understand the degree of safety, I suppose, from a sort of, there's very little that can happen to the demand for what Watkin Jones sells in order for that to become a problem. Obviously, the finance drying up is not the same thing as there not being a demand for the housing. There's definitely a demand for the housing. The bit that is heading in the right direction now is the demand, or sorry, the availability of finance, and also the willingness to invest into the sector. Obviously, when interest rates were a lot higher, now while SONIA is used for mortgages, obviously the base rate is used for pricing up, sort of money market. So that obviously, that coming down is benefiting investments like PBSA, because it makes it relatively more attractive, compared to sort of risk-free rates. That the risk rate for investing into accommodation, student accommodation, becomes more attractive as interest rates go down. Okay, so it's that's kind of the this was another one that was mentioned that wasn't in the any RNS or on the Watkin Jones website, but a Battersea project with 762 beds across 3 towers, with 55 affordable homes on top, and that was back last month. So again, there's at least 3 deals that I've identified today that aren't on an RNS anywhere, aren't on a website, or they aren't on the Watkin Jones website, but they're sort of bubbling along. So the chances of none of these ever becoming a forward sale seems quite low to me. Anyway, and also to say that the pipeline has grown by 500 million. Back in um, back in September, it was, or back in the September results, the pipeline was 1.4 billion. So 1.995 is a big increase. And anyway, I've sort of talked through this diagram. You've seen that on my spreadsheet, so won't repeat myself there. I think the point about all the assumptions I made, I've obviously talked through those, and also that it only really takes some pretty low amounts, on the basis that each property is 286k. It only takes 300 home scheme, and then the following year a 700 home scheme, for this then to sort of get to a break even. So the point about them losing money, they lose money unless and until they sell that many PBSA beds or that many BTRs, okay, or other things. I mean, or refresh deals and so on. So anyway, I just think this, this is a mega pessimistic assumption here. And as you can see, this final column is where I talk about the sort of, in a normal world, they would be selling about 500 million a year of projects on a 12% margin, which is a lot lower than historical, but I've gone with 12% with that same overhead cost. And then tax gets you to 22.5 million, and 22.5 would, at 10 times would support a market cap of 225, and obviously the market cap today is 63, so there's a 4 times upside really to where this should or will be at some point in the not too distant future. And actually, if you go back in time, there was a time that Watkin Jones was at 700 million, and fundamentally, like, the business hasn't changed. Like, the demand for the business is services and products hasn't changed. I'm not saying it deserves to go back to 700 million right now, but it was valued at that at one point. So I mean, even if you sort of said, well, 15 times, I mean, gets you to a 45 million, sorry, 450 million market cap. So which would be a third less than the 700 it once was at. And actually, when you compare it to sort of companies like Harworth or Granger's on 22 times earnings. So fundamentally, Watkin Jones, I mean, if it can get back to these kinds of levels of profitability, would comparatively be on like 2.4 times earnings. So it would be sort of almost 10 times cheaper than Granger is kind of what I'm showing you there. If it can get to that point. Now, obviously, it only takes another kind of couple of deals for that 292 to get to 500. It's not impossible. It's certainly not impossible. Certainly not impossible. So that sort of covers pretty much the idea. And I've sort of said here that, whilst you could look at the results and go, they're very sort of meh results, the underlying points about the fact it's had to deal with all of that problem with cladding, the problems with the financing to deals, and obviously they've done other things like partnerships to sort of innovate to get deals across the line. So rather than just having an investor, that they've sort of taken a stake in projects. So I think the Stratford one is where they've taken 25% stake. So that, again, the interesting thing there will be that the 25%, there's they'll get a 25% share of the profit of the sale of the finished project to a university or to a landlord, or income from students if they don't sell it. That if it's managed, that they're entitled to a share of profits that way. So again, there's sort of just other reasons to think this isn't as bad as all of that. And yeah, that sort of concludes really this talk through. So anyway, that's enough from me. Oak Bloke saying cheerio for now. Cheerio.